So thank you for joining us at FutureMoneyTrends.com. I have a very special guest today. He is a fiduciary advisor. Now, for anyone listening to this show, there are many, many brokers out there. Most of people, that's who they deal with, is a broker. They work off of a commission. You might even go to a mutual fund and think you're paying a low fee, but actually there's tons of fees, sometimes upwards of 17 small hidden fees that add up to a lot over time. And Nicholas Green of FMT Advisory is a fiduciary advisor to the point that he is mandated by law that where if he bought a stock, IBM, in the morning, and then he bought it for you later that day, he has to give you the better price. So it's good, honest, unbiased, and it's very important to have people like this around you. And that's why I go to him often for investment advice and good counsel. Nicholas, thank you so much for joining us today.
Daniel, thank you so much for having me on your show, Future Money Trends, and it's a pleasure to join you and your viewers here today. And I'm happy to be here.
Well, hey, Happy New Year to you, by the way.
Thank you. And by the way, last time we spoke last week, you had mentioned that you were reveling in the fact that you had come into a good, set of cigars from a mutual friend, and I didn't get any cigars, and so I was sort of heavily brooding on this over the weekend.
Well,
a little distraught, lamenting over the fact that I didn't get any of these good cigars. So I have a solution, and I've come up with one. So the next time I'm in the Austin area, I'm going to take you to Hill Country, and I'm going to run you into the ground. We're going to run about 20 miles. And then when we're done with that, you're going to have to share one of your cigars with me on top of a good bottle of scotch.
Well, I don't know about scotch. My family drinks scotch, and I can barely stand it, but I love wine. So I'll do some wine and some cigars.
That's good, but the scotch is on you.
That's fine. If you make it all the way to Texas.
I've been drooling all week. I like to get an occasional cigar, so I've been drooling over the whole weekend over this idea that, wow, Daniel's got these really good cigars, and I don't have them right now. So this was my solution.
These were perfect, and the secondhand smoke, you just wanted to bottle up in a jar and save it for later. My fingers, for at least the next 12 hours, just smelled like candy.
Well, good for you. I'm glad you're enjoying it.
All right. So, on to the global markets. There's a lot going on in the past 7 days. The S&P 500, the major indexes, had their worst start of the year ever. If Nicholas, if you could just kind of walk us through kind of your recap of 2015 and how you foresee 2016 playing out.
Sure. That's a great question. And so let me just throw out some names for you for fun, just off the top of my head. Century Management, Greenlight Capital, Delisle Street, Fairholme Capital, Longleaf, Third Avenue, Pershing Square, Penza Asset Management, Bapus Group, Warren Buffett, Berkshire Hathaway. What do all these people have in common? Great asset managers, great money managers. They're all doing horribly, and especially towards the back half of 2015. All of them are getting slaughtered, and so I can say that I'm doing much better than all of them, and so that's very good that we're doing better, and FMT Advisory is doing better. But the point is this: these are great money managers that will come back. But I wrote an article in, I think, June or July, that said don't count on the Fed for a soft landing. And the difference here, in sort of my view and the way I see the world, is between me and all these asset managers, and the only reason why I've done better is because one of my largest holdings and accounts have been cash. And I haven't taken a dogmatic view on the Fed and the Federal Reserve for really two reasons. And one is I've always felt like either the Fed is totally clueless, or the Fed is one of the most self-serving evil empires in the universe, or potentially a combination of both. And I think it's actually a combination of both. So if we go back to when the FONC meeting in October, do you remember what happened, Daniel, when they met in October and what they didn't do?
Well, in September they didn't raise, but I do not remember in October. What happened?
Okay, so it was September, October time frame. They didn't raise, and the market was sort of expecting them to raise because they've been promising all year they were going to raise interest rates. And And so the premise at the time was, well, they're going to raise because they've been promising they're going to raise. But you started to see turmoiling in international markets. And so international markets started to really struggle. And when they didn't raise, their excuse was, well, the international markets are seeing a lot of tumult, a lot of turmoil, and so we are going to hold on rates for now. And just before that, the Chinese finance minister Wang Yi had actually reached out and said, discussed with the Federal Reserve, like, look, we need some financial stability around the world. And so when the Federal Reserve raises rates, while you have every other currency in every other country plummeting, raising rates and tightening monetary supply in the U.S. only drains liquidity out of those countries and the flow of funds even more to the U.S. And so it only exacerbates the problems over there. Well, so let's fast forward to the last raise. The problems have only gotten worse internationally, and meanwhile, what did the Fed do? They raised rates a quarter basis point. And so this is my point, is the Fed, and if you were paying attention, there was a lot of sort of side noise about how the Fed was worried about the public's perception of them, and that they may lose credibility if they don't raise rates, because they've been talking about raising rates for so long. And so they finally raised rates under the premise that the economy is really strengthening, the job market is wonderful, and the markets can now handle interest rates rising. So the international markets are worse. The 5-year forward break-evens on inflation is declining, it's accelerating down. There's no sign of inflation out there as far as core inflation, yet they're raising interest rates. And so this is my point, is either the Fed is totally clueless, or they're completely self-serving, or they're a combination of both. And I think it's a combination of both when you just look at sort of what they've been doing. I think it's been self-serving, trying to preserve what, credibility they think they have left, or, they're clueless. And I think it's actually a combination of both, because if you look over the last 20 years, they've almost invariably been clueless. I mean, you remember what, Bernanke in 2006, right, the subprime is contained. I think you probably remember that as well.
Well, and none of them have also ever had a real job. For the most part, you look at their resumes; they've got great degrees in economics, but then from there they became college professors, or they worked for the government directly. Yeah. And then they went on to, Yellen really, it's almost like the president. Some of the people running this country, you look at their resumes, and they've never actually had to go through any real hardship of trying to financially overcome something. They've just always had this, this academia circle, or this, I don't want to say business owners have it harder than an employee, but an employee or a business owner has in the normal world, in the real world, has to overcome and accomplish things and meet deadlines. If you're an economist and you're just making forecasts, and you're always expected to be wrong, the bar is so low.
That's so true that they don't really have much in the way of real world experience. But what is even more concerning is that even with that being so, they certainly have the data that, for example, what's going on in China is very, very important to the global economy, in that, they raised interest rates a quarter basis point, and I've been talking about this for a while, but what happened in December was China pulled out another $100 billion of foreign exchange reserves out of U.S. treasuries. So $100 billion came out in December, I believe, over the year. Over a half of trillion came out of U.S. treasuries from China. So as we've entered this credit cycle, very similar to what we went through in 2008, 2009, China's entering their credit cycle right now. Their credit is starting to get severely impaired, and so as the Fed knows this data, which goes back to my premise that they're very self-serving and clueless. But so as we raise rates and we even put the screws to China even more, they have to pull more reserves out of our foreign reserves. Raising rates while everyone else is easy or trying to get more easy around the world, it doesn't make a whole lot of sense. It just creates more global sort of chaos. And so what happens when we raise rates? China has to pull and drain more liquidity out of our markets. And so the Fed's starting to tighten. That tightens currency supply, so it makes currency supply tighter in a market where you have debt saturation. And then on top of it, you have liquidity drain with China having to pull liquidity out of our markets. You have the dollar strengthening and then all the other international currencies weakening. So this is deflationary. And so if you look at what the Fed did, it's a policy error. And so this is all financial stuff, right? This is jargon stuff. This is right up their alley. This doesn't have to be real world. This could be the data they're looking at. We know they have some very good data, but why they're not making good choices is anyone's guess. Again, I go back to my two premises, but is that they're clueless or self-serving. But so we have this going on, and you have the Fed tightening. And what is the market saying? The market is saying we've got a policy error, right? Since the Fed has tightened, you've got a bid on long-term treasuries. So 7, 10-year, 20-year treasuries actually have had a bid. Utilities are one of the best outperforming sectors in the market. Cash has been terrific, and the market has gotten crushed, and oil has declined materially. This when you usually the very first basis point rise in any kind of interest rate cycle, the markets don't have much of a reaction to it. Even in the 1930s, it took 3 interest rate hikes before you saw any market reaction whatsoever. You're seeing enormous carnage out there with a single quarter basis point interest rate rise. The Fed is clueless.
Yeah, and you know what? It's interesting. In previous cycles, we've seen gold rise in times of interest rates rising, whether it's in the 70s or early 2000s. Gold seems to be going up a little bit since then, but nothing too dramatic. Nicholas, we only have about 3 or 4 minutes left here, but just for people who watched what happened last week, you're a value investor. That's what you do for your clients. You look for value. You did say you're in a lot of cash right now, so obviously you're not finding too much value, I'm guessing. But, often value investors talk about ignoring the noise. Is this one of those moments, or is there a real problem here going on right now in China?
There's a real problem going on in the world. It's not just China, but China is currently sort of in the headlines and causing the problems. And so yeah, the reason why the whole list I gave you, the reason why I've been doing much better than is just because I'm a little more. I'm a value investor, but also I've been very in tune to valuations. So sort of my strategy has been, one of my biggest holdings has, of course, been cash. But the other thing that I've been more than delighted to be adding to in here, which has been a fantastic holding for me for a long period of time and for my clients, but it had a pullback early in the year, and it's been, I think, fairly. It's been in a good value zone recently, but one of my biggest equity holdings, and it's called my Hit the Fan stock, and I haven't sort of disclosed the company in my emails to our members at FMT Advisory, which people are more than happy to go over there and read our articles and get my emails for free. But I haven't disclosed the company, but I'll disclose it here because most people will be confused and not buy it by the namesake of the name. But this is a company that I took a large position in too in the 2008-2009 crisis. It's a company called Fairfax Financial, and they're on the Toronto Exchange. It's run by Prem Watsa and his team, and they took huge bets against Washington Mutual, Fannie Mae, Freddie Mac, J.P. Morgan, Goldman Sachs in the credit default swaps markets. And it was my way to play the housing bubble and subsequent crash was by buying Fairfax Financial. And I've owned it ever since, and it's been a great company. It's run by great people.
Fairfax is the one tied to it's like the Warren Buffett of Canada, right?
It is, but they go to the beat of their own drummer. I mean, they definitely have different. They get to the same destination in a totally different way than Buffett. And for the reason why the company's been doing relatively well over the last 2 years, and it's starting to go up nicely again, and it's been performing really well in this really, really tough market, is because Tom Watson and his team have huge bets. So it's a way to be long deflation, right? Right now, we're in a deflationary mindset. The psychology of the marketplace is deflationary, and China is making things deflationary, right? A credit cycle and a credit contraction, by definition, is deflationary, and this is reverberating around the country. And it's why all the list of great leaders I gave you to start off the interview, why they're all doing tough, is it doesn't matter if you're buying a company significantly intrinsic value, if you're going into credit contraction. You're still going to temporarily lose money. It'll be temporary. And I'm adding into some names as this market comes down, so don't get me wrong, I'm not all Fairfax. But Fairfax is a great way to play it because they have these huge bets right now on deflation. It's a way to be long deflation, and it's a heads I win, tails I win type of investment over the next, over the long haul. Whether or not this plays out or not, it won't matter. Fairfax is sitting on about $1.1 billion cash on a corporate level. They're sitting on $7 billion cash in their equity portfolio. Their equity portfolio is 100% hedged, and they've got some big bets on deflation happening, and they're starting to pay off in a big way. So you're starting to see the company and the stock go up as this is playing out. And so when people are afraid of credit contraction, they're afraid of deflation, there's a lot of money out there still sloshing around, and it's finding its way into companies like Fairfax. And there's other companies that are undervalued too. But this is probably my largest position, or if not close to it. It's right up there, one or two largest position at FMT Advisory throughout my portfolios. And it's a company that I plan to even add to if I can. It's harder to add to for smaller accounts because it's a company that sells in the $600 range. And if people look at price and think that has anything to do with that, whether it's expensive or not, they need to call me immediately. But Fairfax is a great way to do long deflation, and and whether it plays out or not won't matter because the underwriting ratio of their insurance operations right now, the combined ratios are off the chart. They're just minting money right now, which is a form of great leverage without having to be levered. And it's one of the reasons why conglomerate insurance holdings with great asset managers that are managing the insurance flow, why they tend to massively outperform just about everything over the long period of time because they get leverage without taking the risk of margin and leverage that and managing equity portfolios. And so Fairfax is a great way to be long deflation right now. But that's what the market is telling you. The Fed is clueless. They're making a policy error by raising rates. And so cash, long-term treasuries, utilities, Fairfax, these are the things that have been outperforming since the Fed raised rates. And the really disturbing thing is you had two talking heads on CNBC last week talking about how they need to raise 3 or 4 more times over the next year.
It's incredible what's going on right now. The economists are clueless, like you said, that are running this world, and we're in a big crisis, people. Nicholas, if somebody would like to get a hold of you, either subscribing to your free letter, which is amazing. I've been reading it. We get about two letters from you a week. Great updates, great ideas you're offering people. This is all free. Of course, you also have an advisory company where people can call you. What's the best way for someone to reach out to you?
Sure, they can reach me toll free at 888-649-6556. That's 888-649-6556. They can contact me directly. They can email me, and like you said, they can also go to FMT Advisory and join our email subscriber list. I call you a member when you do because we're in this together, and as a team, I think as a unit, we're all stronger together. So anyone paying attention, your viewers are probably really in tune with what's going on in the world, and I think we make a great match to help people sort of navigate through these extraordinary times. And I've been through extraordinary times before, and I've sailed right through them, and I have no doubt that just sort of with our risk management and the way we do things, that we'll be ultra successful. So I welcome anyone to join me and to give me a call.
Yeah, if anyone has a question or comment or would like to chat with Nicholas, I will definitely make sure the phone number that he just gave us is posted. Thank you so much for joining us on the show today, sir. Nicholas Green, CEO and Chief Strategist for FMT Advisory.
Thank you, and make sure you save one of those cigars for me because I'm coming after one of them.
Will do, sir.